You're about to learn something that will fundamentally change how you see the global financial system. Not because I'm going to show you conspiracy theories or fear-mongering predictions, but because I'm going to walk you through verifiable historical patterns that have repeated with mechanical precision for over 5 centuries. Patterns that every major economic power has followed right up until their collapse. And patterns that suggest the United States is currently approaching the final stages of its economic dominance. Let me start with a number that should immediately grab your attention. $38.4 trillion. That's the current U.S. national debt as of December 2025. Now, I know what you're thinking. You've heard big, scary debt numbers before. Politicians talk about it. Economists debate it. Financial media occasionally mentions it between stock tips and crypto hype. But here's what almost nobody is telling you. This isn't just another fiscal problem that can be managed with policy adjustments or economic growth. This is a mathematical progression toward an outcome that has played out identically 3 times in modern history with 3 different global superpowers. And the most disturbing part, we're not at the beginning of this cycle. We're not even in the middle. Based on observable patterns in current capital movements, the United States is approximately 12 to 18 months into the third of 4 predictable stages that precede the collapse of every reserve currency in recorded history. Now, before you dismiss this as doomsaying or sensationalism, I need you to understand something crucial. What I'm about to show you isn't opinion. It's not speculation. It's documented economic history with verifiable data points, public filings, and treasury records that you can check yourself. Every claim I make will be backed by specific evidence. Every pattern I identify will be demonstrated across multiple historical examples. And every conclusion I draw will follow logically from observable facts. By the end of this analysis, you'll understand exactly where we are in this cycle, why it's mathematically inevitable at this point, and most importantly, what happens next. But more than that, you'll understand something that most people never grasp until it's too late. The warning signs are always visible. The smart money always moves first. And the people who get destroyed are always the ones who convince themselves this time is different. So let's begin with a framework. A pattern that's repeated across centuries with such consistency that once you see it, you can't unsee it. The 4-stage cycle of reserve currency collapse. Every major reserve currency in modern history has followed a predictable 4-stage progression from dominance to irrelevance. This isn't a theory. It's a documented pattern that's played out with remarkable consistency across drastically different time periods, political systems, and technological contexts. The stages are: Stage 1, ascendancy and capital accumulation. This is the golden age. A nation emerges as the dominant economic and military power. Capital flows in from every corner of the world seeking safety, returns, and opportunity. Their currency becomes the standard for international trade, not through coercion, but through practical necessity. If you want to participate in global commerce, you need their currency. Financial institutions expand. Markets deepen. Innovation flourishes. Confidence becomes absolute. This stage typically lasts between 50 and 80 years. It's characterized by genuine economic productivity, fiscal responsibility, and institutional credibility. The reserve currency status is earned through demonstrated competence, not just military might. Stage 2, overextension and monetary expansion. Success breeds complacency. The government begins spending beyond its productive capacity. Military commitments expand globally. Domestic programs multiply. Social obligations increase. All of it funded not through taxation or savings, but through debt accumulation. The deficit becomes structural, not cyclical. But here's the insidious part. Because they control the reserve currency, they can finance deficits simply by printing money. Other nations can't do this without triggering immediate currency collapse because they need to buy foreign currency to settle international debts. But the reserve currency nation can simply create more of their own currency because that's what international trade settles in. This creates a false sense of sustainability. Asset prices rise. Real estate booms. Stock markets reach records. Everyone feels wealthy on paper. The economy appears to be thriving even as the underlying fiscal position deteriorates catastrophically. Central banks suppress interest rates to make debt service manageable, which inflates asset bubbles further. This stage typically lasts 20 to 40 years. It ends not with a crash, but with a subtle shift that most people don't recognize until it's too late. Stage 3. Silent capital flight. This is the critical inflection point. The people who actually read balance sheets, major institutional investors, foreign central banks, wealthy families with intergenerational perspectives, begin to recognize that the fiscal mathematics have become unsustainable. Not in some distant future. Right now, they don't announce this. There are no press conferences, no dramatic declarations. They simply begin systematically rotating capital out of the reserve currency and into alternative jurisdictions, currencies, and assets. The movement is gradual at first, barely noticeable in aggregate statistics, but it accelerates with mathematical precision. Foreign central banks reduce their holdings of sovereign debt. Corporations shift operations and investments internationally. Wealthy individuals establish accounts and assets in foreign jurisdictions. The brain drain begins as talented professionals emigrate, seeking better opportunities. This stage is particularly dangerous because the general public doesn't see it happening. Asset prices may still be rising due to domestic money printing. Employment statistics might look stable. The political establishment insists everything is fine, but behind the scenes, the foundation is crumbling. Historically, this stage lasts between 18 and 36 months from initial acceleration to critical mass. And once it reaches critical mass, stage 4 becomes inevitable. Stage 4. Collapse and currency reset. The currency loses reserve status. This doesn't happen through official decree. It happens through market dynamics. Countries simply begin settling trade in alternative currencies. Foreign central banks dump their accumulated holdings. The decades of printed money that was absorbed by international demand suddenly comes flooding back into the domestic economy. Inflation explodes. Interest rates spike. The government faces an impossible choice: raise rates dramatically to defend the currency, which makes the debt completely unserviceable and crashes the economy, or continue printing, which destroys the currency through hyperinflation. Either path leads to the same destination. Asset prices collapse as liquidity evaporates. Banks fail. Pension systems go insolvent. Insurance companies collapse. The middle class, which holds most of its wealth in currency-denominated assets, gets completely destroyed. Political chaos follows. And everyone asks the same question: how do we not see this coming? The answer is always the same. The pattern was visible. The smart money saw it. They just moved quietly. Now, you might be thinking this is theoretical. Interesting as economic history, but not particularly relevant to modern policy. So let me prove this pattern is real by walking you through 3 specific historical examples, spanning 5 centuries, with radically different contexts but identical outcomes. Case Study 1. The Spanish Empire, 1500s to 1600s. In 1500, Spain wasn't just a European power. It was the global superpower in a way that's difficult for modern people to comprehend. Spanish galleons were returning from the Americas with quantities of gold and silver that literally doubled Europe's money supply within a few decades. The Spanish real became the world's reserve currency out of practical necessity. If you wanted to engage in international commerce, you needed reals. Madrid became the financial center of the known world. Capital flowed in from across Europe, Asia, and Africa seeking returns. Spanish banks financed trade routes spanning 3 continents. The future appeared limitless. Stage 1. Complete. King Philip II controlled territory spanning from the Americas to the Philippines. Spanish armies were considered invincible. The Spanish Armada ruled the seas. Colonial wealth poured in continuously. Confidence was absolute. Then came the spending. Wars with France. Wars with England. Wars with the Ottoman Empire. Wars with the Dutch. A military presence on 3 continents requiring constant financing. A massive bureaucracy consuming fortunes. Royal palaces and cathedrals costing more than entire provincial budgets. The Spanish Inquisition burning money along with heretics. By 1550, annual Spanish government spending was running at approximately 300% of tax revenue. 3 times what they collected. The difference was financed through debt. Italian banks. German merchant families. anyone who would lend. But this seemed sustainable because gold continued flowing from New World mines. Asset prices in Spain kept rising. Land values soared. Spanish nobles grew wealthier on paper. The empire seemed invincible. Nobody questioned the fiscal mathematics because the currency was literally made of precious metal. Stage 2. Complete. But starting around 1555, something subtle began happening. Major Spanish banking families started quietly moving assets to Genoa and other Italian city-states. The Fugger family of Augsburg, Spain's largest creditors, began demanding repayment in physical gold rather than promissory notes. They wanted out of paper claims and into hard assets. In 1556, wealthy Sephardic merchant families began transferring operations to Amsterdam. Not suddenly, not all at once. Gradually opening offices, moving inventory, redirecting trade routes. Why? Because they could read financial statements. And the statements showed that Spain was functionally bankrupt despite the gold flowing in. The Spanish government was paying interest rates of 40% on some loans. 40%. That's not the rate you pay when you're financially sound. That's the rate you pay when creditors view default as highly probable. Stage 3. Verified. In 1557, Spain defaulted on its sovereign debt for the first time. Credit markets froze. Spanish bonds became worthless. The government seized private gold shipments from the Americas to pay soldiers. Financial chaos spread. But King Philip promised it was temporary. A one-time adjustment. Normal service would resume. Trust the crown. Spain defaulted again in 1560. Again in 1575. Again in 1596. Again in 1597. For sovereign defaults in 40 years. The currency collapsed. Inflation destroyed the middle class. Spanish power evaporated within a generation. By 1600, Spain had gone from the world's dominant superpower to a second-tier European power. The Golden Age was over. It never returned. The Spanish real lost its reserve status. International trade shifted to other currencies. Stage 4. Complete. Where did the capital go? North to the Dutch Republic. Amsterdam became the new center of global finance. Which brings us to our second case study. Case Study 2. The Dutch Republic, 1600s to 1700s. By 1650, Amsterdam was the richest city in the world by every measurable metric. The Dutch East India Company was valued at approximately $8.28 trillion in modern currency. More than Apple, Microsoft, and Amazon combined, multiplied by 2. Dutch banks financed global trade. The Amsterdam Stock Exchange was the world's first. The Dutch guilder became the reserve currency for international commerce. Capital flowed into Amsterdam from Asia, Africa, the Americas, and Europe seeking returns. The city in the 1600s was simultaneously Silicon Valley, Wall Street, and the city of London compressed into a few square miles. Banking innovation flourished. Financial instruments we use today, stock options, futures contracts, credit default mechanisms, were invented in Amsterdam during this period. Stage 1. Absolute. Then came military overextension. 3 Anglo-Dutch wars between 1652 and 1674. Conflicts with France. Conflicts with Spain. A global colonial presence stretching from Indonesia to Brazil to South Africa, requiring constant military financing. Government debt increased from 4 million guilders in 1650 to over 80 million by 1690. A 20-fold increase in 40 years. To finance this, the Bank of Amsterdam began inflating the money supply, printing guilders beyond what gold reserves could back. Meanwhile, asset prices detached completely from economic fundamentals. Tulip mania hit in 1636 to 1637, where rare tulip bulbs sold for more than houses. A single Semper Augustus bulb sold for 10 times an artisan's annual income. Complete speculative insanity. And here's what almost nobody knew at the time. The Bank of Amsterdam, supposedly the safest financial institution in Europe, was secretly lending out depositor money to finance government wars. They were running what we would now call a fractional reserve system, where they claimed to hold 100% of deposits in reserve while actually lending most of it out. Classic Ponzi mechanics wrapped in institutional legitimacy. Stage 2. Verified. Around 1670, major banking families began quietly relocating operations to London. Sephardic Jewish merchants who had made Amsterdam wealthy started moving. Portuguese trading houses opened offices in England. German financiers systematically pulled capital out over several years. Why? Because insiders knew what the public didn't. The Bank of Amsterdam was functionally insolvent. Had been since 1672. They were using new deposits to pay obligations to old depositors. The fraud was kept secret through accounting manipulation and governmental protection. But those with inside access could see the real numbers. Stage 3. Documented. In 1795, French revolutionary armies invaded. The Dutch Republic fell. The guilder collapsed. The Bank of Amsterdam's fraud was finally exposed publicly. Depositors lost everything. Riots erupted. Political chaos. The Dutch Golden Age ended in months after 150 years of dominance. Stage 4. Complete. Where did the capital flow? To London. Britain became the next financial center. The cycle continued. Case Study 3. The British Empire, 1700s to 1900s. At its peak, the British Empire controlled approximately 23% of the world's population and 25% of Earth's landmass. The pound sterling served as the global reserve currency for over 200 years, longer than any currency in modern history. The City of London was the undisputed center of global finance. Need capital for railroads in America? Go to London. Mining operations in Africa? London. Plantations in Asia? London. Over 60% of international trade settled in pounds. The gold standard was literally built around sterling. British financial power seemed eternal. Stage 1. Absolute. Then came the 20th century and 2 world wars. World War I cost Britain approximately 44 billion pounds, over $600 billion in modern currency. They borrowed from America, from their own citizens, from anyone who would lend. Government debt went from 30% of GDP to 130%. Remember that number. 130% debt to GDP. Because it's almost exactly where the United States is today. Britain tried to maintain the gold standard. Failed in 1931. Tried again after briefly returning. Failed again in 1933. The system was fracturing. World War II accelerated everything. More debt, more money printing, more promises the economy couldn't support. Britain ended the war, technically victorious, but financially destroyed. Stage 2. Complete. Around 1949, the quiet exodus began. Major British corporations started shifting operations to America. Unilever, Shell, British Petroleum, not abandoning Britain entirely, just redirecting investment capital elsewhere. Wealthy British families transferred assets overseas, to Switzerland, to Canada, to America, anywhere that offered better returns and lower tax burdens. The brain drain accelerated. Scientists, engineers, entrepreneurs, academics, all emigrating to America where opportunity and growth were still possible. By 1960, foreign investment in Britain had fallen 62% from pre-war levels. The money was leaving. The talent was leaving. The future was leaving. Stage 3. Documented. In 1967, the pound devalued 14.3% overnight. The government had exhausted foreign currency reserves trying to defend the exchange rate. They had no choice but to devalue. Citizens woke up one morning to discover their currency was worth 14% less than the day before. In 1976, Britain went to the International Monetary Fund for an emergency bailout. A bailout. The former global superpower that had financed the world's infrastructure for 2 centuries was now begging for emergency loans like a developing nation. The humiliation was absolute. The pound lost reserve currency status. International trade shifted to dollars. Britain's financial dominance ended permanently. Stage 4. Complete. Where the United States stands today. Now, let me show you exactly where the United States is in this cycle using the same framework. Stage 1. 1945 to 1971. After World War II, the Bretton Woods Agreement established the US dollar as the global reserve currency. Initially backed by gold at $35 per ounce, the system created massive demand for dollars internationally. Capital flooded into America as Europe and Asia rebuilt from war devastation. U.S. financial markets became the deepest and most liquid on Earth. Everyone wanted American assets, stocks, bonds, real estate, treasury securities. The American century began. This lasted from 1945 to 1971. 26 years of genuine economic dominance. Stage 1. Complete. Stage 2. 1971 to 2020. On August 15, 1971, President Nixon ended gold convertibility. The dollar became pure fiat currency. No commodity backing, just confidence in the U.S. government. And what happens when you remove all constraints? Spending explodes. Look at these numbers. 1971, $398 billion national debt. 1980, $909 billion. 1990, $3.2 trillion. 2000, $5.6 trillion. 2008, $10 trillion. 2020, $27 trillion. January 2025, $36.1 trillion. December 2025, $38.4 trillion. That's a 9,650% increase in 54 years. The debt has more than doubled in just the past 5 years alone. But government debt is only part of the picture. Total U.S. debt across all sectors. Corporate debt, $13.5 trillion. Household debt, $18 trillion. Student loans, $1.77 trillion. Credit card debt, $1.13 trillion. Auto loans, $1.63 trillion. Total U.S. debt exceeds $100 trillion. That's approximately 370% of GDP. For historical context, Spain defaulted when debt reached 200% of GDP. The Dutch Republic collapsed at 250%. Britain lost reserve status at 130%. The United States is currently at 370% and accelerating. The government now pays over $1 trillion annually just in interest payments. More than defense spending. More than Medicare. Just interest. Not paying down principal. Just interest. And how is this financed? Through money creation. The M2 money supply increased from $15.5 trillion in February 2020 to over $21 trillion by April 2022. A 40% increase in 26 months. The largest monetary expansion in American history. This created predictable outcomes: inflation, asset bubbles, and wealth inequality. Stock markets at all-time highs while real wages stagnate. Price-to-earnings ratios at dot-com bubble levels. Housing prices up 73% since 2019. Commercial real estate overvalued. Bonds in historic bubbles. Every asset class simultaneously inflated. The Federal Reserve's balance sheet expanded from $800 billion in 2008 to over $9 trillion in 2022. They purchased treasuries, mortgage-backed securities, corporate bonds, artificially propping up asset prices across the board. Stage 2. Complete and verified. Stage 3. 2023 present. Now here's where it gets critical. The silent exodus has begun. And it's not speculation. It's documented in public filings and treasury data. China held over $1 trillion in U.S. treasuries in 2013. Today, approximately $760 billion. They've sold over $300 billion over the past decade. Documented. Public record. Month-by-month selling. Japan, the largest foreign holder, reduced their position by $220 billion since 2022. Continuous selling. Monthly reductions. Saudi Arabia is reducing holdings. Belgium reduced exposure significantly. Switzerland selling. France reducing positions. Even the Federal Reserve itself is conducting quantitative tightening, allowing bonds to mature without reinvesting, actively draining liquidity from the system. So who's buying U.S. debt now? Primarily the U.S. government itself. The Federal Reserve. Government pension funds. Internal accounts. Circular financing. Printing money to buy your own debt. That's not strength. That's desperation showing through official policy. And it's not just governments. Major financial institutions are restructuring portfolios. BlackRock, managing over $10 trillion in assets, has reduced U.S. Treasury exposure while increasing positions in emerging markets, European infrastructure, Asian real estate, gold, and commodities. J.P. Morgan has restructured institutional allocation recommendations. Goldman Sachs reduced U.S. equity weightings. Morgan Stanley increased international diversification guidance. Bridgewater Associates has warned about dollar devaluation for years and positioned client portfolios accordingly. The smart money is moving. Systematically. Quietly. Just like they did before Spain's collapse. Just like before Amsterdam's fall. Just like before Britain's decline. We are currently in stage 3. The capital flight phase. Based on historical patterns, this stage lasts 18 to 36 months from initial acceleration to critical mass. The significant foreign selling began accelerating in mid-2023. That suggests we're approximately 12 to 18 months into this phase currently. What stage 4 looks like? Based on historical patterns and current trajectories, here's what happens next. The dollar gradually loses reserve currency status. Not through official announcement. Through market dynamics. Countries begin settling bilateral trade in alternative currencies. It's already happening. China and Brazil are trading in yuan. India and Russia settling in rupees. BRICS nations, Brazil, Russia, India, China, South Africa, now expanded to include Saudi Arabia, Egypt, Ethiopia, and Iran, are developing alternative payment systems. These countries represent over 40% of global GDP and are actively building infrastructure to bypass dollar-denominated trade. A critical point about the so-called petrodollar agreement. There was widespread reporting in June 2024 claiming the petrodollar agreement had expired. Let me clarify what actually occurred. The 1974 U.S.-Saudi Joint Commission on Economic Cooperation did expire. However, there was never a formal written agreement requiring Saudi Arabia to price oil exclusively in dollars. It was an informal arrangement. That said, Saudi Arabia has recently indicated willingness to accept alternative currencies for oil transactions. They've explored yuan-denominated contracts. The practical effect is the same. The dollar's exclusive grip on energy markets is weakening. When dollar demand drops significantly, what happens to the dollars currently held by foreign central banks? They come flooding back into the U.S. economy. Decades of printed money that was absorbed internationally suddenly returns home. That's when inflation accelerates dramatically. The Federal Reserve will face an impossible dilemma. Option A, raise interest rates aggressively to defend the currency and control inflation. But the U.S. is $38.4 trillion in debt. Every percentage point interest rates rise adds $384 billion to annual interest costs. At 8 to 10% rates, interest payments alone would consume the entire federal budget. The debt becomes completely unserviceable. Economic collapse. Option B. Continue printing money to service the debt and maintain government operations. This destroys the currency through hyperinflation. Savings evaporate. Fixed incomes become worthless. The middle class gets destroyed. Either path leads to the same destination. Asset prices collapse as liquidity disappears. Stocks, bonds, real estate. Everything deflates simultaneously. Banks fail when loan portfolios default and bond holdings lose value. Pension funds go insolvent as assets crash while obligations remain fixed. Insurance companies collapse when they can't meet claims. The middle class, holding most wealth in currency-denominated assets, savings accounts, government bonds, money market funds, gets completely wiped out. Retirement accounts vanish. Home equity disappears. Decades of savings evaporate. Political chaos follows. Social unrest. Institutional breakdown. And the universal question, how do we not see this coming? Why this time is different is always wrong. I know exactly what some of you are thinking right now. But America is different. We have the world's strongest military, the most advanced technology, the best universities, the most innovative companies, nuclear weapons, global reserve currency entrenched for 80 years. This time won't be the same. Let me address this directly, because this psychological trap has destroyed every empire in history. Spain had the most powerful military in the 1500s. Didn't prevent economic collapse. The Dutch Republic had the most advanced financial technology of the 1600s. They literally invented modern capitalism, stock markets, central banking, derivatives, credit instruments. Didn't prevent collapse. Britain had the largest empire in history. Industrial revolution, global navy, unmatched trade networks. The sun never set on the British flag. Didn't prevent collapse. Military power doesn't overcome fiscal mathematics. Technology doesn't stop currency debasement. Innovation doesn't overcome structural insolvency. And exceptionalism is just the story empires tell themselves right before they fall. But the Federal Reserve can print infinite money. They'll never let the system collapse. They printed infinite money in Weimar Germany. Hyperinflation destroyed the middle class. Savings became worthless overnight. People needed wheelbarrows of cash to buy bread. Political chaos led directly to the rise of the Nazi Party. They printed in Zimbabwe $100 trillion notes that couldn't buy groceries. Complete economic destruction. They printed in Venezuela. Inflation exceeded 1,000,000% annually. Doctors and lawyers working as taxi drivers. People eating zoo animals. Mass immigration. They printed in Argentina. Multiple currency resets. Decades of poverty despite massive natural resources and an educated population. Printing money doesn't create wealth. It transfers it from savers to debtors, from workers to asset holders, from the middle class to those positioned in hard assets. Until confidence breaks, then it accelerates collapse. The pattern doesn't care about your belief system. It doesn't require consensus. It doesn't wait for permission. It simply unfolds according to mathematical principles, like gravity. Practical implications. What this means for you. So what does this mean practically? What should you actually do with this information? First, understand your exposure. If most of your wealth is denominated in dollars, savings accounts, money market funds, government bonds, dollar-based assets, you are exposed to currency debasement risk. Not theoretically. Actually, consider these strategies. 1. Real asset diversification. Gold has maintained purchasing power for 5,000 years across every civilization. It's held value through every currency collapse in history. Silver, platinum, commodities, real assets that cannot be printed into existence by central banks. This isn't speculation. It's insurance against currency debasement. 2. Geographic diversification. If major institutions are moving capital internationally, consider following. Not all your capital, but meaningful exposure. Research stable foreign currencies with better fiscal positions. Swiss francs, Singapore dollars, Norwegian kroner. Spread political risk across jurisdictions. 3. Understand the timeline. Stage 3 doesn't last indefinitely. Historically, 18 to 36 months from acceleration to critical mass. Significant foreign treasury selling began accelerating in mid-2023. That suggests we're currently 12 to 18 months into this phase. You have time, not years, months. Use it deliberately. 4. Increase liquidity. Keep accessible cash reserves despite inflation erosion. In a crisis, liquidity provides options to acquire crashed assets, to move quickly when opportunities appear, to handle unexpected situations. Illiquid assets trap you exactly when you need mobility most. 5. Reduce debt exposure. High debt in a rising rate environment is financially catastrophic. If you're leveraged, consider deleveraging now. Every point interest rates rise makes debt more expensive to service, and rates are structurally moving higher from current levels. 6. Invest in human capital. The one asset that survives every collapse is human capital. Skills that create value. Knowledge that solves problems. Relationships built on trust and competence. These cannot be inflated away or confiscated. They travel with you across borders and economic systems. Conclusion. This isn't fear-mongering. This is pattern recognition based on 500 years of documented economic history. The four-stage cycle is played out with mechanical precision 3 times across drastically different contexts. 16th century Spain, 17th century Dutch Republic, 20th century Britain. Same pattern, same stages, same outcome. The United States is currently in stage 3, the capital flight phase. Foreign central banks are selling. Major institutions are diversifying. Wealthy families are establishing positions in alternative jurisdictions. The smart money is moving. Stage 4 is coming. The mathematics are inevitable at this point. The debt cannot be serviced at realistic interest rates. The deficits cannot be closed through spending cuts or revenue increases without political revolution. The currency cannot maintain reserve status while being printed at current rates. The only variable is timing. And based on historical patterns, that timing is measured in months, not years. I'm not telling you this to scare you. I'm showing you the pattern so you can position accordingly. The people who survive these transitions aren't always the ones with the most money. They're the ones with the best information and the clarity to act on it. Every statistic I've cited is verifiable. Every historical example is documented. Every conclusion follows logically from observable patterns. Do your own research. Check the data. Draw your own conclusions. But understand this. The pattern doesn't require your belief. It doesn't need your acceptance. It simply unfolds like every time before. The information is here. The pattern is clear. The choice is yours. What are you seeing in the current economic environment? What steps are you taking? Share your thoughts in the comments. I read every one. And if you found value in this analysis, subscribe. Because understanding these patterns isn't just about protecting wealth. It's about understanding how the world actually works beneath the surface narratives. Thanks for watching.